All right, happy Friday. It is Friday the 22nd, 3:30. It's a week before Thanksgiving. It's my favorite holiday of the year. I'm really looking forward to that. I go upstate. My mom loves to cook, and so does my brother as well. And so my brother and I often play like Madden football on some like 10-year-old Nintendo system. And I scratch the itch on video games for the year because I enjoy them too much. So I kind of limit my time to them during that hyper competitive 3 to 4 day weekend. I'm really excited about it. I hope you all have great plans too. I wanted to share a few things for you today. One is great article about how the wealthy avoid taxes. It's a topic I don't talk about enough. I'll give you a quick flyover on a few things there. It was prompted by this Bloomberg article, which is the most widely shared article. Come back to that. Nvidia earnings. We got to talk about Nvidia. Third, hedge fund positioning. I'm going to go through a deep analysis that Goldman did around hedge fund positioning here. So I see another game fan as well. By the way, the other thing I used to do before I had kids, around holiday season, I would tell my wife, I said, look, for this 1 week, you're just not going to see me. I'm sorry. I'm going to play like World of Warcraft. It's not going to make any sense. And I'll scratch an itch and then I'll like come back to reality. But when you have 3 kids, you can't do that anymore. In fact, I'm trying to teach my kids the love of gaming. I teach my 6-year-old chess, teach my 4-year-old tic-tac-toe. So we're going to have a lot of fun though. So I want to talk about, plug real quick, upcoming podcasts. I'm interviewing Vishal Garg, serial entrepreneur. He's a CEO of publicly traded firm Better Mortgage. It's the second company he took public, actually. The first one he took public in his 20s, a student lending company. And he's a really incredible founder and individual. He was the guy that, in 2022, he had some notoriety because of this experience. If you recall,
you are part of the unlucky group being laid off. Your employment here is terminated effective immediately. It's been a really, really challenging decision to make. This is the second time in my career I'm doing this, and I do not want to do this. The last time I did it, I cried. This time I hope to be stronger. But we are laying off about 15%.
So I'm going to be interviewing Vishal in 1 or 2 weeks live on a podcast. Known Vishal for 10 years. Look, founder mode is back. The pendulum is swinging to creators and builders. And we're going to talk about his experience there and also just markets. Vishal is a very sophisticated investor. We're talking about mortgage rates, what that means for the economy. Again, he runs one of the largest mortgage lenders nationally. What a great perspective there. I think Vishal is going to go from the villain to the hero arc happens. And I always like rooting for the underdog. And I think it'll be a great experience to talk about there. So here's this article from Bloomberg that came out today. I'm going to share my screen again. Okay. It's called Quant Hedge Fund AQR's Cutting Income Taxes for Wealthy Clients. Okay. Quietly touting a product that can do something extraordinarily potentially divisive, how much income tax its investors pay. Okay. So AQR, for those that do not know, it's run by Cliff Asness, CEOs on Twitter, UChicago PhD economics guy. The firm's been around for decades, New York City, Connecticut based. I think over 1,000 employees, a lot of PhDs, well-known firm. It's a quant fund. It's an asset manager. And, we know them very well. I've been alluding to this in my newsletter, by the way, for some time. We never really gave up the ghost on how we do these things until we talked to our prospects and clients. But AQR is one of the strategies we use to mitigate taxes. I'll share high level how it works. Here's another document which you should read as well. It's on the Lumida Wealth page. If you want to figure out how to eliminate capital gains taxes, this is a good one. So if you go to services and then click on tax shield, so it will explain this, how to eliminate capital gains. I mean, the reason why people don't talk about this is because they don't want them to go away. They don't want these benefits to go away. So Bloomberg wrote an article about it. I think it's the #1 most widely shared article on Bloomberg. So I figure I might as well share at a high level that, these strategies exist. You can minimize or eliminate capital gains, income tax, and passive income. Those are the 3 primary sources of taxation. So how do you eliminate capital gains? Well, you generate capital losses. There's ways to do that while earning return on your capital. That's one. That's what that link I just sent you, it's called Tax Shield, the Lumida webpage. How do you eliminate income tax? There's actually several ways to do it. This is harder than most other techniques. One technique is you generate losses, ordinary losses from a business investment that can be applied against your ordinary income. The 3 techniques to do it. And this is the most esoteric of these kinds of buckets, by the way. Most people you talk to will not know how to do this. Okay, so I'll just leave it there. The third one is how do you eliminate passive income? You do it through passive losses. So passive income is what you get on, say, rental income from your real estate holdings. The way you do it is you generate passive losses. How do you do that? It's called depreciation. So, I'm an investor in a distressed commercial real estate fund. I was talking about last year, distressed commercial real estate. Supposed to invest in that. There's no distress. Look at these publicly traded commercial real estate firms at all-time highs or in equity position. So that's how you mitigate tax. And there's special situations for founders, by the way. So the founder has a life cycle and a journey. I'll give you an example. When I started Lumida, we're a venture-backed, digitally native wealth manager. We want to disrupt Goldman Sachs. Why make fun of them so much? They deserve it. But the first thing I did after we filed our 83B election, which means that you now own par value shares in your company's worth $200. You haven't taken any outside money in. The first thing I did is I set up a trust for my wife and I put all of my shares in there. And then we let it season for 3 months for some technical tax reasons. I won't get into that. And then my wife granted it back into my trust. We both set up what are called spousal limited asset trusts, SLATs. And that was necessary because the VCs would want me to have governance and control over my company. But the reason why that benefited is that a married couple has a dual lifetime exemption of $26 million, meaning you can get assets out of your estate so they're not taxed by the IRS upon your death. And you want to get highly appreciating assets out of your estate at as low a basis as possible. So Lumida is worth a lot more than that. In fact, it would eat up my entire exemption. But only deducted $200 effectively from my exemption because of that technique. I haven't yet to meet a founder that does that, by the way, because no one talks about this stuff. That's the beginning of the founder life cycle. And the other side of it is when you have capital gains taxes, when you're approaching an exit. My prior company I built and sold, I got an exit down to the QSBS exemption, which is another tax strategy. And a lot of VCs know about that, by the way, so that's more kind of in the know. And then there are other techniques such as accumulating carry loss forward so you can mitigate capital gains. So, by the way, I still pay taxes. I contribute to charities of my choice. I'll be making a contribution to my high school. Next week around Thanksgiving is usually when I sit down and do these things. So, but there's a reason why the wealthy don't pay as much in taxes. I mean, there's a lot of things out there. Trump's technique to not pay income tax is called conservation easements. Conservation easements is another technique. So, these are the dark arts of tax. I'm not going to walk you through them all here. These are things that you learn over a long period of time. You accumulate them, you document them. I've only written about one of them on my website, or our website, Lumida Wealth. I will build a tax blog though, talking about all this stuff, because I know a lot of people are saying on capital gains taxes from the significant equity and digital asset rally we've seen in the last 2 years. So people need strategies to mitigate tax. That's a quick flyover. So you can address capital gains, income tax, and passive income. I just outlined briefly some basic approaches around it. Certainly reach out if you want to get specifics around that. We work with founders and owners of businesses that around these and integrate the investment side. So let's talk about Nvidia earnings. All right. So I'm going to share my screen with you here. And overall, I thought the earnings were very strong. In the summer of this past year, I had a webinar, I think it was like July-ish timeframe. And I said that in 2025, we'll see Nvidia with the $200 price target. We were way ahead of the other analysts. Last 1 or 2 weeks, I saw 1 or 2 analysts come out with a $200 price target on Nvidia, by the way, for next year. So that's cool. And when I laid out my argument, I'll be very brief on this. I don't want to cover old ground, but I'll share it with you here. It has to do with analysts' expectations are wrong, right? We have a non-consensus view. Obviously, Nvidia is becoming more and more in consensus over the last 2 years, becoming more and more efficiently priced, but there are still deltas in the expectations for revenue growth. And that delta is in the forward revenue and earnings expectations for Nvidia, right? So I'm going to share my screen here. These are the actuals for revenue, and they're the estimates for revenue on an annual basis. So these have come up. The analysts have been coming close to our direction. We have a DCF model behind this. Essentially, if I were to boil it down, we have a higher expectation of revenue growth in 2026 and 2027. And the analysts expect this to trail off pretty quickly. If you were to boil it down, that's the main variant perception we have. We think the analysts are actually correct on the margins, meaning the margins that Nvidia pays or has due to their price concessions to Microsoft and TSMC. So I'm going to show you Nvidia's earnings transcript now. And this is built with our AI tool. This is a new capability in our AI tool. How cool is this, by the way? I'm going to make this AI tool available to the public in a few months. See, as soon as I start packaging for the public, it slows down my pace of internal development. So I'm prioritizing alpha before public, prioritizing our client interests first. So this is Nvidia's earnings transcript. But what our AI does is I've trained the AI to highlight news and key items. So green is good, red is bad, orange are kind of neither. Orange gives you unique insight into the business or the industry or a read through that helps you think about Nvidia better. So let's take a look. Look, you got to read a lot of transcripts. The alpha is in the transcripts. If you read the transcripts, you will be a better investor. You can understand actually what's happening. So you can see significant revenue growth, 94% year on year, exceeding their expectations. Obviously, market expectations were even higher than this, which is why it's pulled back somewhat. So Blackwell demand is staggering. I love the verbatims because the verbatims give you better insight into management thinking rather than a summary driven by AI. Primary material is better than secondary material. I don't want an AI to tell me that NVIDIA's management expects demand to outpace supply. That's what GPT would say. I'd rather read the sentence. Blackwell demand is staggering, and we are racing to scale supply to meet the incredible demand customers are placing on us. That's far more informative, right? Now it can underwrite the credibility of Jensen, all the rest. Is that statement valid, legitimate? But that primary verbatim is insightful. We talked about Accenture. This is interesting. So Accenture is a major enterprise distribution partner, right? Because they plug into all these corporates and Fortune 500 companies. Again, remember, NVIDIA's revenue is concentrated around Mag 7. So Accenture is a distribution channel in the same way like Dell is a distribution channel. So here's orange. This is a read through to China. We expect the market in China to remain very competitive going forward. We will continue to comply with export controls while serving our customers. Our sovereign AI initiatives continue to gather momentum as countries embrace NVIDIA accelerated computing for a new industrial revolution powered by AI. So he's speaking here to China, also Japan and Saudi Arabia. I expect Saudi Arabia will get export controls lifted under a Trump admin. They want to build 60 data centers. they need Nvidia GPUs. Gaming revenue, here's RTX. Again, blue means it's a kind of new product initiative. On the bad news, they expect gaming to be weaker. This is pretty cool or what though? I mean, have you seen any software that does this, by the way? Have you seen any wealth manager that does this either? I don't know. We have a lot of cool analytics in-house, by the way. I'm just showing a glimpse of what we do here. But when we release this to the wild, I hope it's a shock and awe moment. So we have every supplier on the planet working seamlessly with us to do that. They're talking about distribution and enabling Blackwell. Okay. Let's see. The growth year over year is tremendous. They're talking about data center. And the key thing about Nvidia is that they're not playing the same game as AMD. They're selling data centers, whereas AMD is selling GPUs. They're playing the game at a different level. I don't think people fully understand that. We have seen substantial growth for our H200s. This is the Hoppers, the predecessors to the Blackwell platform. Our hopes and dreams, this is Jensen, the CEO, our hopes and dreams that someday the world does a ton of inference. And that's when AI has really succeeded. It's when every single company is doing inference inside their companies for the marketing department, the forecasting department, the supply chain group. And of course, coding. I agree. That makes a lot of sense. You saw Klarna dismantled their service team of dozens of individuals and replaced it with AI. When can we disrupt the IVRs? Who wants to call their bank and wait in line? I call my Merrill Lynch concierge service. I had to wait 30 minutes in line to request them to get a priority reservation at a dinner spot. And that didn't work out either. And AI can do that much better, right? So the future can't come quick enough. Let's see, what else? The demand for inference, great. We see inference demand going up. Let's see. Okay, cloud service providers are racing to be the first. That's a key insight. That's a read-through to others in the category. These cloud service providers, not only they're customers of Nvidia, but they're actually distribution partners in the sense that they package these chips to make them usable for the end market. And Oracle's a part of that, Google, Amazon, and Microsoft. And of course, it's a strange bedfellows because several of those suppliers have, or cloud service providers have custom silicon, like Amazon, where they're trying to wean developers off of Nvidia chips onto their own platform. The ramp is incredible. Almost every company in the world seems to be involved in our supply chain. Yeah, look, I could go on and on. So it's a good story. It's a good story for Nvidia. Again, I'm not going to spend time on the numbers. We have a nice summary here, by the way, too. This is a summary of the transcript because we need to get to the main highlights. I'm working on improving this summary. I'd like a little bit more depth, a little bit more detail. It's not bad. I guess the main idea. And here's the original transcript. If you want to see, you want to fact check anything. So that is a quick transcript analysis for Nvidia. Let me see if I can pull up Oracle really quick. This is a new feature, by the way, I rolled out. So this might take 5 minutes to run because I have no caching. It's not optimized for speed. It's not optimized for inference yet. So what happens when I run the transcript, then it's doing work in real time. It's pulling information from different places. And so we'll come back to that. I think it's going to run in the background, but that was pretty cool, right? It's like live application of AI. If you're not using AI, your competitor's going to eat your lunch. There's no reason why the next Merrill Lynch needs 10,000 people. You just need 10 people. You'll have AI doing servicing, AI doing marketing, AI driving investing. That's our view of the future. All right, let's shift gears now. Okay, before we get into the hedge fund positioning, I want to talk about this recession stuff. All right, so you saw initial claims. Initial claims came out. And here they are. US weekly jobless claims at 7-month low. Home sales rebound in October, and the mortgage rates are high, by the way. When people get married, they need to have a home. It's called household formation. When people separate, someone needs to go buy a home. Someone needs to sell a home. People influx of immigration, people need homes. So, and the other part is people will buy the home and then refinance at lower rates. That's how they make peace with higher mortgage rates. Yes, it does crimp disposable income, but the priority is shelter and living. They'll make that decision. And then when mortgage rates decline, that'll actually create a boost to disposable income. So there's a future tailwind that has not yet been realized in the economy. The tailwind is mortgage rates declining for those individuals that have taken out mortgages in the last 2 years. Now, to get the unlock for people that took out mortgages like when I did at 2.5%, that's not going to happen. I told my wife we're not moving for 10, 15 years. So that's going to take a lot of time. But for folks in the last 2 years, you can refinance. So there's very little evidence of large layoffs taking place. Of course, there was no recession. There's no recession here. Initial claims dropped. I think people have hyperactive amygdalas, the fear center, right? Investors are their own worst enemy. So I get it. Look, if you're not a professional investor looking at the data like we are all day long, you haven't been doing this a long time, your sense of fear will override, what does David Hume say? Reason is a slave of the passions, right? Your fears will come out and cause you to make a bad decision at the exact worst possible time. That's what happens when you're supposed to be buying an opportunity. I'll do my best to flag when we see weakness. I don't see it. In 2022, I was bearish. You can look at my comments on digital assets. You can look at my comments on equities and Amazon. I was bearish then. Then I turned bullish in early 23. We'll see. I don't know. We'll see if we can do it again. But we're on top of it. I don't see any sign of a recession. Quite the contrary. I think, the Trump election is equivalent to 100 basis points in cuts. It's massive. Let me show you something else. The day of the election, or day after, remember I said that the NFIB small business survey would come in strong. And let's take a look. The small business optimism index. Where are we on this index? Let's find a chart. NFIB measures small business sentiment. Like small business is the primary driver of job creation, so it matters. Okay, I'm gonna share my screen. And let's take a look. Confidence is increasing. We had peak levels around 2019. I think by the end of next year, this will be back at peak levels, and I think it's going to recover very, very swiftly. It's called animal spirit. It's what John Maynard Keynes, who, by the way, was actually an excellent investor. I know a lot of people don't like Keynes for different reasons, and because of his thesis on deficit spending, this and that, but he got a few things right, more than a few things, especially around animal spirits. I'll tell you an interesting anecdote, and then we'll get to the hedge fund positioning document, which is the main focus here. I was at an auto parts store replacing brakes in my car. Go there once a year, and I'm waiting to get serviced. Guy walks in the door, and it's like a blue collar part of town, right? And the person behind the cash register looks at the person who walked in, and they smile at each other. And the guy behind the cash register says, "Trump's going to fix everything." That's what he said. I'm not making a political comment. I'm just sharing an observation in reality. And the other guy says the same thing. And they give like a kind of small guy hug thing. Now imagine that instance taking place across 1 million individuals around the United States. That's what's happening. It's a sense of optimism. By the way, these are probably low information voters that are consuming one source of content from Fox News, whatever, right? It doesn't matter. It doesn't matter. It changes the psychology. The psychology is different. That's what's happening. So you're going to see more small business confidence. You're going to see more hiring, more activity, more investment, people on the margin making a better spending decision. You're going to see retail sales do very well this quarter, I expect. So that's what's that's what's going to happen here. So yeah, hope. It's not hope, my friend. It's going to happen. It's going to happen. It's happening. So you can see it on the markets, right? So the markets are discounting greater earnings. So let's shift gears now. Let's talk about hedge fund positioning. So this was a report generated by Goldman Sachs. We won't hold it against them for doing that. And talking about portfolio rotations, okay? Let's take a look at what these hedge funds are doing. And I think the question is, where do we agree or disagree? Where do we think consensus is correct? Where's non-consensus? Where do we have a non-consensus view? So hedge funds remain on track for a strong year of returns. 14% year-to-date return, lagging the S&P, by the way. What a terrible, terrible performance. In any case. The Mag 7, excluding Tesla, rank as the most popular hedge fund long positions. By the way, why don't we take a quick look at Mag 7? You know, my favorites are Nvidia, Meta, Google, and Amazon, the recent entry into the fold. We take a look at the year-to-date returns. Nvidia, Meta, Tesla actually came up out of nowhere. Amazon, Google, DOJ issues around that. And, you know, so hedge funds like Mag 7. Okay. Let's see. Funds continue their return to China equities. That's really funny. I think they got that one wrong. 25% of hedge funds at least own one China ADR. The time to be in China was earlier this year. I think China is actually still interesting, but I think if you went into the FOMO, you're paying your toll gate entry fees. Look at this is China. This is the parabola. Tepper goes on CNBC here, and now you're below those levels. Right, so be careful of hype. Hype usually lasts 1 to 2 weeks, and then the rug pull happens. So let's see. Here are some of the topics: concentration, crowding, thematic tilts, sector positioning, hedge fund VIP list, most concentrated positions, rising, falling stars. All right. I'll try to focus on the highlights. All right. Hedge funds increased net leverage while trimming gross leverage. They got more long, and they reduced the size of their balance sheet. They reduced, you could say they're hedging, which makes sense. They wanted to get more beta. They wanted to get more index exposure. They wanted more exposure to upside rather than on picking winners and losers. Okay. So, okay, the popular names: Amazon, Microsoft, Meta, Google, Nvidia, Apple, among the top list of most popular hedge funds. Well, a lot of them are, this is classic indexing. If you have that many, and if you put Apple in there, that's just classic indexing. All right. Some of the top holdings: App, Levin's, obviously one of our names, Booking, Travel Play, Coupang, Carvana, Discover is getting bought by Capital One, Natural Gas Play, EQT, Expedia, another travel play, Juniper Networks, PayPal, Smartsheets, VST's utility company we used to own, Kellanova, this used to be General Mills. They recently acquired or merged with Mars & Co. They make Mars bars and other confectionaries. Healthcare remains the largest hedge fund overweight. I agree with that, actually. I've been talking about healthcare. And we've been talking about healthcare before I saw this report. So it's interesting to see that every quarter, everyone shows their hands. You see how they're positioned. So you can look around the room and see who else is doing what. I haven't really been interested in healthcare for the last 2 years. And now I'm talking about healthcare because these are some of the best businesses in the world. They're not pro-cyclical, and the US government is one of the customers or companies, and they're mandated by law to have insurance. And you have earnings growth, people are getting older. There's so many aging and longevity tailwinds. It's just, can you get in at a good price is really the question on healthcare. And now you can get in at a good price. I'll talk more about that later. So the hedge fund VIP basket is a select set of Goldman's top hedge fund holdings. That basket has actually beaten the S&P, but hedge funds as a whole have not. Okay, I can show you some of the names in that basket later on. Again, look, it's Mag 7. So Mag 7's done pretty well, right? It's a quick summary way to answer the question. Here are the categories and the popular hedge fund longs. Here are the shorts. So financials, we love financials. I've been talking about financials. I think 20% plus my portfolio is in financials, by the way. 20%. We looked at Druckenmiller's portfolio. Remember last week? He had at least 10 regional banks and he had the KRE index. He didn't own any mega banks. We owned the mega banks last year, like JP Morgan. You remember, during the banking crisis. High quality dislocated asset play. Find the diamond. When everything's on sale, people think the world is ending, find the highest quality asset. The world's not ending. We're getting more liquidity. Rates are decreasing. Margins are going to expand. Now liquidity is going to start flowing out and broadening from the center to the regionals. The regionals are going to do M&A. They're going to buy up the smaller players. They're going to bulk up and get bigger. They're going to cut costs. And the consumer's strong. So we like that. CRE is healing. We're probably halfway through the healing of the CRE, market. So what else do hedge funds like? Utilities, they're all over utilities because of this data center play. Utility is one of the best sectors today. We liked utilities up until 2 weeks ago or 3 weeks ago. Then we sold out. Doesn't mean that it doesn't keep going up, but let me show you utilities real quick. This was our play, Vistra Corp. We had a few. Talent Energy was another one of those, by the way. So I have one utility today. I'll tell you that. But let me share my screen here. All right, I'm back. We had a hiccup here. By the way, it snowed for the first time today, this season. So that's cool. My kids were so ecstatic. Like they want Santa Claus to come like tomorrow now. So if you have any good ideas for 6-year-old, 4-year-old boys, let me know. My 2-year-old daughter has no concept of this stuff right now. We are back. Okay, we were talking about utilities, right? Let's take a look at utilities. So this is my name in utilities. I used to own this, VST. It's Independent Power Producer, IPP. It's a distinct from highly regulated utilities that must get approval from regulators to pass prices on to consumers. This is VST. We got out right here, went back, bounced up. It's down today. Who knows where it goes from here, but we're out of that. The other one we had was Talent Energy. They did a deal with Amazon in Pennsylvania. It's a nuclear power plant. So we got out as well of that one. But I still own NEE. We'll see how that's doing. We got in right here on this day. This is good. It's a good entry. And unlike the other ones, which have a lot of distance from the 200-day moving average, this may have some room to run. So I might be wrong about my utilities exposure. So one way I'm hedging myself is actually getting long anyway, but with a different kind of expression. But my overall utilities exposure is less than the market benchmark. Okay, so let's get back to hedge fund positioning now. Okay, sharing the document again. There we go. This is a table of contents. What else? What are the other categories? Communication services. This includes Meta and Google, the S&P. So they're underweight that versus the S&P. The S&P is this gray outline here. They're mega long utilities. They're mega long industrials like Caterpillar, United Rentals, like Brad Jacobs type companies. They're overweight healthcare. That makes a lot of sense. I'm talking about that, right? Let's take a look at healthcare. Let's look at XLV. You'll see this thing slice through the moving average. Not all the names in this category, by the way. What happened here is Eli Lilly and Novo Nordisk, the GLP-1s, is a major, major theme for the year. Right. So this is attempting to make a nice little rally here. Let's see what happens. This is Eli Lilly. Eli Lilly and Novo Nordisk just got smoked here. I wouldn't want to own those. I would not want to own those. Those things are broken. We used to own Novo Nordisk. You can take a look at when we sold that. This is Novo Nordisk. And it's called competition. So I actually can show you the breakdown of the healthcare sector. Let me see if I can find that real quick for you. There we go. Look at this. This is beautiful. I have a wonderful CFA analyst who makes me look smart, by the way. I'm not. He's fantastic. He creates all these nice dashboards for me too. But healthcare is a multifaceted story, right? It's sold off in part because of Medicare Advantage utilization going up, number one. Number two, threats that the Trump administration will use more generics. We invested in generics, the stock last week. We picked that up from the 13F analysis, by the way. I'll come back to that in a second. Talk about how that's done since then. So this is healthcare. And the third factor is, RFK Jr., what does that mean for health and human services? And pharmaceuticals have really taken on the chin. Take a look at pharmaceuticals right here. So different sectors in healthcare are getting impacted differently. Look at medical devices. They're fine. In fact, they're all-time high. Why? What does medical device have to do with pharmaceutical regulation or health and human services? If people are using healthcare more, people are still going to spend on medical devices. So even though the XLV at the sector level is down, you can double click and find an opportunity that might be dislocated. The play we did there was DVA. DVA is a leading manufacturer of kidney dialysis machines. It's got a 15.24 P. We already own this. We bought that around here. I did a stream about DVA. I wrote about it in our newsletter too. DVA is back at all-time highs. This is classic baby in the bathwater opportunity, right? But not all of it. Like, I bought Merck. That didn't work out for me. I think it'll still be fine, but I did de-risk some. Like, if things aren't working in my direction, I will de-risk quickly. I don't mind doing that because I can rotate into a better idea. And we'll see. So I think pharma, look at this 4P of like 11. So leader in oncology, cancer. Unfortunately, we haven't cured cancer. Hopefully AGI can help us around that, but we're just not there yet. So healthcare, I agree. I agree with this overweight on healthcare. People really aren't talking about it. Financials, talk about financials. Look at the bid for financials. This is really interesting. Look at KRE index. So we have quite a few different bets in financials. I won't walk through them all today, but you see how it doesn't even get back to the moving average. It's a bid right away. It denies buyers a good entry. That's the same thing as saying institutions want to own this. We also bought on this day, by the way. I was like, we just got to buy this thing because it might not get back here. So names we own are names I've talked about as well. Like LPLA I would not buy here, but we own this. Bought it over the summer. This is a wealth management business, right? Western Alliance Bank. This was in the headlines last year. Remember Western Alliance Bank? 2.6% today. Remember Flagstar? This is Steve Mnuchin's bank. Up 8.5%. That's pleasant news. I did not know that before I clicked into this. That was great. If you think CRE issues are priced in for the stock, then that's a good one. The whole underwrite's on CRE because the price to tangible book is very low. Each of these banks have a slightly different story. CFG has actually been on wealth management. They acquired a boatload of advisors from First Republic. I've talked about CFG back when I was at the Permissionless conference. So FCNCA, This is the bank that bought Silicon Valley Bank. If you're a bank that gets a blessing from the FDIC to buy another bank, you're a healthy bank, you're a good bank, you're in the good graces of the FDIC, all-time highs. Financials. I've been scooping up insurance companies too. I've been talking about these categories for a while. It's going to be a 2-year trend. Jackson Financial up 3%. We picked some up earlier this week. We had a nice little pullback. I think a lot of insurance names are really interesting, actually. And I'm spread betting here because they all meet my criteria, and I want to expose myself to the right tail outcome. The mistake would be to try to pick the perfect insurance stock. That's a mistake because I'm limiting myself from having exposure to the power law distribution of returns, which VCs know this. You make 50 investments, a handful of them drive the vast majority of returns. What if I make the wrong decision here? If these all meet my criteria, I'm not saying own the entire insurance sector, far from it. I don't own, for example, Marsh McLennan. I don't own Aon. I don't own United Health. But the ones that meet my criteria, I want exposure to. And that's what we saw Druckenmiller doing with the banks too, if you recall. I recommend taking a look at the video from last week around Druckenmiller. It's a breakdown of his strategy and approach. I have 40 positions now, 45. And at the year end, I'm going to get a GIPS compliant audit so I can share my returns with you because the SEC will not permit me to tell you my performance. Okay, but it's better than the S&P and more than by a little. And we have 40 positions. Is that okay? That's statistically significant. So give me one quick second here. I'll be right back. Okay, so let's get back to the hedge fund positioning here. All right. So they're overweight real estate. So what are they underweight? Materials. Yeah, materials. These are actually low quality businesses. You're exposed to the commodity prices. China's on their backs. They're not beating up commodities, but this sector has rallied recently. So there's a tactical idea here to own some commodities. But I don't think this is a great sector overall. I did pick up a materials play. ASPI is a materials play, by the way. So we own that one. So try to find the leader in the category. But I this bit the biotech I'm talking about here. Let's go back to materials, XOB. Yeah, so right here we picked up some materials. Like every now and then you see these obvious setups. I have an ETF chart book we look at every Sunday. Every now and then you get an obvious setup like this. And like, okay, we'll go buy the material stock. Sure, why not? But I agree with that. These are not quality businesses, material companies. They're cheap as hell though. And if you believe on a cyclical recovery, which I do, with central banks cutting, then demand for materials will go up. So having some exposure is not a bad idea. Let's see. Energy, they started overweight. I think that makes sense too. Let's see. What else? Okay. Some statistics. Short interest. What are they shorting the most? Defensive sectors. Why? Because we have a recovery. There's no recession. So the money's going from defensives, such as healthcare, which is sold off, to the cyclical categories, right? Real estate has also sold off a bit. What are the cyclicals? Financials, technology, industrials. It's going to benefit from things like CHIPS Act, infotech as well. Advertising dollars will go up, right? Let's see. Stocks with the largest shorting, I don't want to spend too much time on this. It's always kind of funny to take a look though. So which ones are short? DJT, they're short Lucid. This is an EV. This company burns money. This company and Rivian, they just burn a lot of money. There's no point in owning EVs. It's in a bear market. So the whole category, on semiconductor, APTV, NEO, just stay away from the category. One day they'll be dirt cheap. Not now though. Now is not the time. And if you have the repeal of the Inflation Reduction Act, then why do you want to get near this category? So Celsius Holdings, a favorite Twitter retail stock. It's way too expensive. And you're seeing multiple compression around this, right? Don't chase what was hot yesterday, right? So don't chase what's hot today. What does Druk say? Don't invest in the present. Look at Celsius. It's still 34 forward PE. It's still expensive. Look at where it's come from, by the way. Look at where it's come from. This is the trailing PE. It was at 68 times. Look at that. And it's been doing this long march of multiple compression. So if you want to own this, you have to believe that earnings growth can outrun multiple compression. The math on that is hard. Why wouldn't you try to get multiple expansion and earnings growth and a variant perception working for you at the same time? That's what I try to find. It's hard to do. App 11 was an obvious one. It's actually not obvious, because when you see it, you say, maybe I'm wrong. What does the market know that I don't know? Right? ASPI was obviously one too. They're reporting today. Here's one we picked up recently, CLS, Celestica. It's actually a data center play. We bought it around here. That's up about 60%, multiple expansion. We bought it, had like a 16 times forward PE. Let me show you. It's a Canadian company. Chamath said Canadian companies are not investable. I think he's wrong. That's really, really silly, naive comment, by the way. I mean, really, really silly comment. Don't get me started. Okay, it was at 11.2 times earnings. It was dirt cheap. Who says you can't make money buying value stocks? Here's another one, Flex. So we own this. I love this kind of trend too, and the characteristics of it. I'm not saying it's a great entry. No, it's not. It was earlier this week. So I don't want to get off track here. Let's go back here. So these businesses are the opposite traits of what I just described. Gap had a big rally today because it had strong earnings, and it was highly shorted by these hedge funds. So the hedge funds got it wrong on this one. I don't have a view on it. This is up 13% today. Really, Gap was a cheap source of funding for these hedge funds. It's not like they're actually betting on that it will fall. Maybe some of them are. What they're trying to do is own more of what they like, and they have to fund it with something to do that. So you're trying to short something that you don't think will run away from you, that will maybe just stand in place, that you don't have to pay a dividend on. Otherwise, you might short like high yield bonds. We got to pay a dividend on high yield bonds. You got to pay out the coupon. So Gap was a great short simply because it just didn't go anywhere. But you had this volatility compression, hung out the 200-day moving average. All the sellers sold. Some positive news came in. Stock is cheap. Short interest is high, and then it rallied. Right? Hindsight's 20/20 though. But so that's Gap. Sirius Satellite Radio. This is a Buffett stock. I have no idea why he's buying this thing. I've looked at it several times. I'm not sure why the hedge funds are short Apollo. I've talked about Apollo and Mark Rowan several times. I won't get into that. Stocks with the decreases in short interest. Natera, this is a drug stock. Quite a few hedge funds actually own this one. I've looked at it. I can't get there. Shift 4, interesting to see that there. I don't know if there's much insight around that. Crowding decreased, hedge fund portfolio density increased. Okay, so hedge funds are getting more concentrated. Talking about portfolio turnover, thematic tilts. This is more interesting. Thematic tilts, right? Because humans like stories, and themes are stories, right? Data center is a theme. Asian longevity is a theme. Reshoring is a theme. The rebuilding of American infrastructure through industrials is a theme. Let's see. Okay, hedge funds rotated to Mag 7 during 3Q. Mag 7 did sell off, right? So I think that was actually a good idea. I like that idea. All right, so this is Mag 7, Mag's ETF. You'll see that it had sold off in third quarter, it's around here. So indices, the S&P and QQQ are at all-time highs, and this was not. These are great businesses. They just had sold off, and they presented a good entry. So let's see. Hedge funds shifted towards cyclicals. That makes sense. What are the cyclicals? Financials. We talked about that. Energy. We're waiting for the energy bid to come. Depends. Like on the one hand, you see it in names like XLE, which have recovered nicely. But in other categories like tankers, you have not seen that yet. Let's see. This is XOE, right? It's recovered, all-time high. So that's cyclical. Now, these are the big integrated oil and gas majors like ExxonMobil and Chevron, and those kinds of players. Look at the holdings. Those are the players that they go. ConocoPhillips. I like Shell. I wrote about this on Monday. Like, I don't know why you own a dividend. I don't know why you own treasuries. If the fact that Shell exists, it's a UK-based oil and gas, and it's nice and cheap right now too. I've been accumulating around here, 8.44 PE, and the price free cash flow is 6 times earnings, and they buy back 8% of the stock every year. Natural gas play on it too. Anyway, I think that's interesting. So it might not run fast, but I think it's just a good risk-adjusted return. It's a good risk-adjusted return. I don't expect I'll lose money on that. I think the upside's greater than the downside, right? So mutual fund performance for the first 8 months of the year was weak, but has stabilized. Okay. Let's try to find some actionable insights here. Hedge funds bought China ADRs during 3Q. This is great. All these guys they FOMO'd into David Tepper going on CNBC. They're all human. They're all human. They make human mistakes also. So I disagree with them on this call. Burry's got a boatload of Chinese stocks. I'm sure they'll do great in 3 years, by the way. I think they will actually in 2 or 3 years, maybe even a year and a half. But tactically, it's a wrong move to make. What else? All right, sector positioning. So you can see the hedge fund. So healthcare, 17% away. I agree with that. I like that idea, as I mentioned. Industrial is a little bit pricey for me right now. I get where they're coming from. Consumer discretionary. Well, this includes Tesla, it includes home builders, it includes retailers, it includes so many names. I want to be more precise around my exposure here. I like home builders, for instance. I do think Amazon is interesting. It's not like a great deal right now, but it is interesting where it is. I like communication services, which is Meta, even names like Comcast, financials. I would have at a much higher weight. Healthcare and financials for me are my two significant overweights. Materials underweight. I get it. I agree. Energy, I'd weight more. This is my mean reversion play. I think energy, is important because it gives you mean reversion. Financials give me momentum. Knowledge gives me momentum, but I want a balanced portfolio. So that if momentum doesn't perform, energy will. And energy has a very good negative correlation to technology stocks. So consumer staples underweight. That makes sense actually. Look, there's no recession. So people are hiding in stocks like Coke. Let me show you Coke. Coke is a Buffett stock. He's owned it since 1986. Look at the damage in this thing. This is just typical. I mean, I could show you Pepsi. It's like the same chart. This is Coke. So it's recovering here. We'll see what happens though. That's a big drop though, right? And that's not a pleasant experience to have to go through. So I own this for a hot minute around here, by the way, on this right here. And then one of my clients, he has another account that he has a play account. He texts me, he says, "Welcome to the Coke Club." No, we bought it like around here somewhere. Anyway. And then it broke down and boom, I'm out. I'm just out. I took my 2% loss on it and I was done. And we were in it for like 3 days. That's just risk management. I don't mind paying for that risk management because I can avoid this damage behind it. A lot of people struggle with that and it hinders performance. But you have to have other good ideas that are competing to make that strategy work. Okay, so hedge funds continue to rotate towards financials. Yep, we saw that. I showed that in the carry chart not too long ago. I got to learn more about this one, Flutter Entertainment. I've seen this come up a few times. I don't know this business well enough. Casinos and gaming. I see a lot of hedge funds owning like Caesar stock and some others, and some of those are because of like they're complex special situation ideas. And I don't know. I do own HGV, Hilton Garden Vacations. I don't know these financials that they're picking up. Here's some of the names. ICE is a quality business. It's a world-class business. I don't own it, but I keep looking at it. People like window watching that one. So here's what's happening. I love this graph, by the way. It's a nice little way to represent this kind of information. So you get the tilt versus the Russell. So on the right-hand side, these are overweights relative to the Russell benchmark. And then on the y-axis, it's the tilt versus the last quarter. This is showing the time. So it's showing where the marginal dollar is flowing over time and versus the Russell. So this top two box is getting focused. This is hotels, resorts, cruises. All these have been working, right? Royal Caribbean, cruise lines, travel, Expedia and the bookings of the world. We'll see how long Expedia and booking survives in the age of AI. I think it's too early for that disruption to happen now, but that's something to be paranoid about. Application software, obviously that's app. Cloud stocks have started to rally, I think, in part in sympathy with app moves to entertainment, right? So this is a consumer story right here, right? This is a consumer story, and I think a lot of seniors are going to spend more money because they're going to have more confidence as well. And you're seeing overweights on biotech, but they've been reducing their pace of investment. So they're reducing exposure to bio. This is all because of the news we saw, right? RFK Jr., what does that mean for health and human services? What does that mean for pharmaceuticals? So they're afraid of this category, right? They're pulling back. They were overweight and they're pulling back. Here are categories that they just really don't like at all. Tech hardware, that's like SMCI's tech hardware, right? Managed healthcare, this is Medicare Advantage. It'll be interesting to see next quarter. I bet you managed healthcare is actually on the right-hand side. I bet you they're accumulating managed healthcare right now. We saw that. But we saw that healthcare is getting a bid right now. Underwear, but adding. So, okay, they're picking up some semis, some autos. I like the auto category, certain names. Obviously, my name there is GM. Let's take a look at GM real quick. I want to own more auto. It's just hard to pick good spots. GM was up 5% today. That's great. All right, we're back again. Sorry about that. I think we got a lot of people watching this live stream here, so it's creating issues. Look, if you're listening to me talk on a Friday afternoon before a big holiday weekend, you are motivated. So I applaud you. That is really cool. By the way, I clearly need to get a new laptop. I went into Best Buy and I was checking out these AI laptops. So the AI laptop is you push a button on the Microsoft Surface and it pops up an OpenAI instance. It's Microsoft branded. Essentially, it's an OpenAI instance. And that's it. Now, instead of being an OpenAI cloud, it's on the Microsoft cloud. And it also has real-time transcription. That's the value prop of AI laptops right now. So it's underwhelming. Do I think it'll drive an AI upgrade cycle for PCs and laptops? No. Next year, maybe, because I think the apps are coming. But I think it's a little too early right now. So there's GM. This has been a sleeper, right? Been quiet, like a lot of buybacks. And I've talked about this one for a while, but I love ideas like this. The United Auto Workers Union was the low for the stock. Everyone hated it, and it's quietly been doing quite well. Price free cash flow 7.7 times. Buyback yield is 20%. 20%. And how have they done performance-wise? Year to date, 63%. Okay, that beats a lot of names in Mag 7. So there are things you can do in value. Value is working, guys. Value is working, especially if you have free cash flow and buybacks. A buyback means a bid is there, and they're reducing the denominator. It's a burn mechanism, right? And if no one's talking about it, you can be ahead of the crowd. I don't think you should buy it here, by the way. It's already up 5%. just to be clear. I just happened to stumble across this because I saw that the hedge funds were talking about this. So I just want to share how I'm positioning, where I agree or disagree with them. I don't like many of the automobile companies, by the way. I think in that category, you can actually pick the leader. In my mind, it's GM. There are other players in the category. There are like 7 players I'm looking at in the supply chain of auto that are really interesting, but we have to do some more work there. It's a category I don't know well, so you have to take time to learn it. As a generalist, that's the trade-off. As a cross-asset class investor, you have to constantly be reading and learning of the market, the players, the dynamics, what products people want, et cetera, ICE versus EVs. So, okay, hedge fund VIP list. Let's take a look. Let's take a look at what hedge funds like. All right, there we go. This is fun. Amazon, Meta, Microsoft. Microsoft's getting more buy ratings, by the way. I don't like the CapEx spend, but I will call that out. Alphabet, Nvidia, Apple, Taiwan Semiconductor, Netflix, Hess, Visa. Give me 1 quick second. I'll be right back here. All right, there we go. We are back. Vistra Corp, we talked about that. Talon Energy, Apollo, okay, interesting. MasterCard, Kellanova, we talked about. Travel and Leisure, Carvana, interesting battleground stock. I don't own it, but I don't like battleground stocks. I'd rather fight the war no one's fighting. What else? Okay. Let's see. So interesting ideas to research here, right? Insight in a biotech category. It's good for idea generation. None of these really pop for me. I'm not terribly excited about them. Synchrony is interesting. I own their competitor, Innova. But this is a good example of maybe it makes sense to spread some bets. The risk is if Trump follows through on his statement in September, capping credit card interest rates at 10%. Now, Innova's not a credit card issuer. They provide subprime loans, and they've limited competition. By the way, let me show you this real quick. I showed this over the summer, by the way. I think some of you folks may know this. Free cash flow divided by market cap, 50%. Buybacks, 10%. Okay. They're buying back their stock. The PE, when we got in this initially, was like 6. It's a good business, limited competition. Year-to-date return is 89%. And it's a value stock with a PE ratio of 4 PE of like 10, and a trailing PE of 16. You don't have to make investing too hard, right? So Synchrony is an interesting idea, actually. I think it's a good idea. Synchrony creates all those retail private level credit cards. You go to Macy's, some of you are going to do Black Friday shopping. That Macy's credit card, that's powered by Synchrony Financial. Synchrony does the underwriting, the credit decision on the back, and they provide all the rails, and Macy's the brand. It's a co-brand partnership. I used to be in this industry many years ago, by the way. So 1 or 2 things. I did pick up some Western Digital, and actually, no, I picked up Seagate. I picked up some Seagate last week. I thought about it after looking at Druckenmiller's holdings. I was like, you know what? This is actually a data center play, and no one's talking about it. And the entry was just compelling. The entry was pretty good. It was right out there. I was like, all right, let's take a look. Let's take a look at Seagate. But it's a cheaper way to play data centers. All the storage that's going to be needed. All the memory. I prefer Seagate over Western Digital, technically. Western Digital is cheaper though. So GoDaddy is an interesting idea too. It's just too expensive for me, but I like that business. Leader in domain management, right? So least concentrated hedge fund holdings. What pops out here? You got some data center plays in Prologis, Blackstone, Prudential Financial Insurance. We like that. Industrials, Deere and Caterpillar. Deere shot up recently on earnings, by the way. I don't own it. I think this industrials category is just a bit overbought. Let's take a look. John Deere, a great American brand, a brand that sells products all over the world, like Caterpillar. It's just too pricey for me. So when things are pricey, they generally, they start running into issues at some point. So where's the mispricing? It doesn't mean I won't keep up with the S&P or beat the S&P, but I just don't see a mispricing there. Okay, Rising Stars. Okay, some of these are interesting. Maybe Raymond, I haven't looked at Raymond James, but I like wealth management businesses. Those are great. Those are quality compounders. TGX is a retail play. They reported recently. Nvidia we talked about. That's a kidney dialysis player. Oh, this is the largest. These are stocks with the largest increase in number of hedge fund owners. So ICE, we mentioned. What else? Equifax, Donaher. These are interesting ideas, I would say. Let's take a look at this one real quick. We had actually looked at this company. We did not pull the trigger on it. I'm glad we did not. But what does this company do? I'll share that with you. So professional, medical, industrial, commercial products in biotech. Yeah, biotech's just taking it on the chin, right? So because of all this political risk, and that one also took it on the chin. So it's been out of favor. Equifax is a business I'd love to see someone destroy. People seem to have forgotten about the third-party data privacy breaches. It's a dinosaur company. It's also an oligopoly. It's too expensive. So stocks in the Russell 1000 that have the biggest decrease in hedge fund ownership. Apple, that makes sense. Apple re-rated after the whole AI thing. Now it's really not going anywhere. HubSpot, Disney, Qualcomm, Western Digital. We just saw the chart. Western Digital is lagging Seagate. You can see why, right? Hedge funds are selling it. Bath and Body Works makes sense. Aren't people buying these products on Amazon now? Amazon's killing Ulta. Remember Berkshire flipped out of Ulta. Let's talk about Ulta. By the way, Berkshire actually did a trade on this. This is what Berkshire bought Ulta a few months before he sold out of Ulta. So he actually did buy it somewhere around here, if memory serves. And he announced in his recent 30th that he's completely out and the stock just tanked again. So he actually did a quick flip. Now, what really happened is he just changed his mind. Buffett's not really a trader. But nothing wrong with that. It's good that he changed his mind. Blue Owl. So they're selling Blue Owl. Makes these asset managers have run up quite a bit. I can get that. Semiconductors like Lam, Supermicro, because they're exposed to China exports, right? Dell, AT&T, Viking Therapeutics. Okay, I wouldn't want to own those names, I think. What else? Top ETFs by hedge fund ownership. Okay, so let's read this table. These are the hedge funds listed on the left. It's the ticker. This is year-to-date return. And the long amount, the short amount, the net amount. This is the gross amount. Okay. So the net position is what you want to focus on. And it looks like they're hedging with the S&P because they're trying to beat the S&P. That makes sense. They like the core S&P 500 ETF. They have a net exposure there. And Bitcoin is an overweight. Look at that. How about that? IBIT, BlackRock Bitcoin ETF. Now, this is holdings as of September 30th, 2024. So they did really well. Bitcoin did very well since this day. Maybe hedge funds know what they are doing, at least as it relates to that decision. China, I think, as I said, they got wrong. Here's the short positions in the hedge fund VIP list. Again, the hedge fund VIP list is the basket that Goldman creates by surveying the holdings of a bunch of hedge funds, right? So these are where the hedge funds have short positions. Tesla, popular short. A lot of what you're seeing now is short covering, by the way. That's really what's happening in Tesla. It doesn't mean it's less legitimate of a rally, but it does change how you approach that. And in Q4, you should not be shorting on average. You shouldn't be doing that. So I remember I was interviewed on Yahoo Finance. I said, and they asked me, what would be the catalyst for Tesla to drop? I said, there might not be one because you have Fed cutting rates into Goldilocks and you have Q4 seasonality. That's what's playing out. Now, Q1 is a different story, though. So until then, enjoy the party. AMD, JP Morgan. That's interesting. They're shorting JP Morgan. Huh. It's a quality bank. It is expensive, but let's see. Palantir. Okay, they're shorting Palantir. Palo Alto Networks. Adobe. I can get the Adobe short. I can see that. I'm not saying I don't do that now. I'm not saying you should do that either, by the way. But how does this company survive mid-journey? And you can see it's in a downtrend since February. It's a bad trend. 200-day moving average heading down, right? It's going to be subject to some technology disruption, I would expect. Starbucks had a new CEO. It popped. They have a lot of exposure to China. I don't own this, but I think these are interesting names to look at. The Starbucks. So since they brought in the new CEO, it's done not so bad, right? Up 2.5% today. It's still too expensive, like 33 times forward earnings. When I want to buy Amazon, the thing with Starbucks is that you walk in, it's all carbohydrates, and it looks like it's been prepared 3 days ago, and it's in this plastic wrap, and it doesn't look fresh or appetizing. What about like a breakfast wrap made of eggs that's warm that you can sink your teeth into with some nice Tex-Mex sauce on that? They should put me on the board of Starbucks. I will fix up that place. Good. Look, people don't want carbohydrates are yesterday. Seed oils are yesterday. That's not what people want to consume. Right? Or protein smoothies rather than sugary drinks. That's a much better call. Protein smoothies. Lean into health and wellness, right? So stocks with changes in popularity. Reddit. So you can find these are stocks that are potentially going meme, right? And Reddit's a meme stock, right? So Upstart, meme stock. Okay, TGX is a retailer. Calanova. Raymond James popped up again. All right, look, we've popped up too many times now. Let's go take a look at Raymond James. And this is kind of my approach, by the way. I do like to do some discovery and wandering and see where the curiosity takes you and find interesting ideas. So I wouldn't buy this kind of business here, but obviously it's run up like LPLA. And it's a nice business, though. I mean, it's a wealth management business. You're long earnings growth. You're long the American economy. You're long the S&P going up. Return on equity is 20%. I don't think I'd buy this, but it was worth taking a look. Booz Allen Hamilton, negative changes popularity. Why? Because DOGE, Department of Government Efficiency. Booz Allen is a big provider to the IRS and other parts of the U.S. government. It's called Booz Allen Worldwide Commercial Services, if memory serves. So government is one of the big customers because the government is too incompetent to actually build technology. They rent consulting companies that have these like 10, 20, 30-year contracts that get renewed again and again. They build the technology. So that's how that works. High short interest outstanding. MicroStrategy, this is funny. So you have hedge funds like Carisdale and others that have been shorting that. Charter Communications, I'm not sure why there. I'd like to understand that more. Resman, I'd want to understand, but can I own that? What is the bear case there? What am I missing on that one? Tractor Supply Company, it's an interesting business. I don't own it. It's worth taking a look at some point. Let's see. I don't like these software names. Datadog, these are wonderful, wonderful businesses, by the way. My prior startup, Datadog, we used to rent from Datadog, incredible, but it's too expensive. Let me show you Datadog. Datadog is a consensus West Coast VC name, and so is MongoDB. If you go to Silicon Valley, you sit down with people there and you ask them what they like, they'll say they like Datadog. Datadog's gone nowhere for a year, and then it reported earnings, and then it went up. Okay, this is the 1 year, gone nowhere. Then it goes up for like 3 days, and now someone feels happy about this, I guess. But it's 300 times PE. Why has it gone nowhere? Because it's expensive. Right. So if you look at Snowflake, this is actually starting to rally too. So cloud stocks have started to rally recently. Right. Snowflake reported earnings. Look at the damage that it's trying to recover from. It had a pretty big jump though. We'll see. We'll see. I'd rather not be a part of this journey though. Right. So what else? Gosh, there's a lot of pages here. So 50 stocks with over $1 billion in short interest as a percentage of market cap. Let's see if anything pops here. Sphere Entertainment. This is really funny. I can see why these guys are being shorting that one. I mentioned this. I was in Vegas for a Money 2020 conference. I drove by the Sphere. I pulled up the stock on my phone. It was like losing $200 million a year, and the strategy is to scale the business. How do you scale losses? I don't get that. It could go meme though. It has meme potential. It's got a story to it. So I don't want to do anything around this, but Supermicro, Mobileye, New Scale. Yeah, these are mostly bad businesses on average, by the way, or overvalued. Some of them will do really well though, because there are left for dead trades in here. Businesses have turned around some of these, they've cut costs, and they can really ramp. So some of these will do well if you do your homework. And let me know if you have an idea. Please do let me know. Many of these are like just hated businesses, and if they can execute a turnaround, they can do well. You see some miners in there. You see like a fake AI company. You see movie theater, Upstart, New Scale. It's like a BS nuclear company. The CEO sold all his shares, but it's like people don't know that. They see small modular reactor SMR, they go buy it. It's a meme. Peloton is trying to execute this turnaround. That's an example of what I mean by a left for dead name that can come back to life because management actually created some value. They tried to do something. So look at Peloton, right? People thought Peloton was dead. Now it's in an uptrend. Right? That's one hell of a rally, right? $3 to $7 too. So if you can find a business in here that's doing a turnaround, that's dirt cheap, there may be an opportunity. Most of these will not be that though. It just takes a lot of time to find that. I have a friend. This is an interesting story for you. I have two stories for you actually, from people that have a lot of wisdom. This guy is like 75, maybe 80 years old. He's a retired money manager. He has an office next to Carnegie Hall in New York City. And he's a very skillful investor. He's met people like John Malone, and he's like the 1 or 2 generations ago kind of investor. And so I asked him about what he invested, and he says, I have 70% of my holdings in the best quality stocks in the world. Now, I don't ask him what those were, but I can imagine what those would be. Those would be things like Visa and S&P Global and ICE and like Moody's. These are like indestructible businesses that compound earnings. They just can't go away. They have a big moat. Maybe Walmart's in there, right? And he says, and so what about the other 30%? And he says, other 30% consists of stocks that you'd be embarrassed to tell your friends about. These are like just dirt cheap, unloved, hated, non-consensus ideas. What we were just talking about there. Maybe something like a Peloton. By the way, I'm not saying by Peloton, I haven't looked at it. I wish I did. I thought about that a month ago. I didn't act on it. It kills me. I wish I did. But so that's an interesting idea. It's a barbell. We describe it as a barbell between quality and junk. Because if you get a momentum rally with animal spirits, which is what we have right now, the best time of year for that stuff to go flying, which you're seeing in a number of names, right? Then that's an interesting strategy. That's an interesting strategy. I had another dinner. I'll share his name because he's a legend. He'll let me do it. His name is Kenny Pasternak, founder of Knight Trading Group. Incredible. This guy shorted banks in the 2008 crisis, went long single-family residential real estate in 2009, entrepreneur of the year, Ernst & Young, built Knight Trading. The guy's a legend, right? And he was also doing these like left for dead trades. Interesting idea. They're just hard to find the right ones, you know? I'm trying to create a process to do that at scale. You need like good screening tools and you get to analyze the transcripts fast. You need technology for that. I think it's doable, but it's challenging. But if you find them, you can do pretty damn well, right? So let's see. Let me know what questions you have. I think we're going to wrap this up. So I see one question came in there. I'll get back to that in a second. Okay. Largest hedge funds in their analysis. Arrow Street, AQR, I talked about around how to save on taxes earlier in the call. A lot of quants. Quants are taking over the world. Look at that. Capital goes to where it's treated best. How many of these are quant funds? 1, 2, 3, 4, 5, and 2 Sigma, and Balyasny, and 72. And Voleridge. I was an investor in Voleridge, by the way, when they had 100 million AUM. That was one of my claim to fame in the alternative investment world. But these are quant funds. Money flows to where it gets treated the best. The best quants know what they're doing, right? This is AI. AI is already here in investing, or it already is here. It was here. Lone Pine, Tiger Cup spin out here. Hudson Bay, I used to be an investor in this fund, really interesting fund. I don't know what they're doing now, but some biotech plays. This whole category should get disrupted, though. They really should. I mean, as a category, they've lagged the S&P. I know some people will defend them and say that's not their job, but then just go buy stocks and bonds if you want to have this performance. What else? Okay. So questions, your process on researching a company. So, well, I'm using my AI tool, first off. So if I have an idea, let's say we have an idea. Let me think of an idea. I can plug in my tool here. Then I'll plug it in. I'll get a quick readout. Okay, so I'll type in, let's say, Flagstar Bank. Okay, I'm going to share this result with you now. Because you need speed. You need to get to know quickly. So you have to find issues fast so you can focus on something else, because most things you look at are not worth spending time on. Okay. Okay, now we'll show Jackson because the AI tool has to build the case for the other stuff I mentioned. All right, so here we go. So I'll plug it into my AI tool like this, and the tool will give me the factor exposures very quickly. Green is good, red is bad, most of the time, not all the time though. And I get a basic sense right now. There's a value stock, the trend is up, it's got a lot of volatility, the balance sheet's good, it's cheap as hell. These are standard deviations. Okay, and the AI generated a thesis for me. So it tells me it's got substantial recent appreciation. It may approach a profit-taking region soon. How cool is that? The AI can tell you at that level. It's not just looking at the fundamental underwrite, but the technical. And it says, it gives me some stats. It says they reported annuity sales. This business sells life insurance and annuities to boomers that are retiring. I'm a thematic investor. One of my themes is the boomers. Boomers are retiring. So what do they need? They need annuities because their risk profile downshifts when they get less income. They want predictable income streams. So I have a whole thesis around boomers. Aging and longevity is a part of that thesis. And so I own several of these names, not just Jackson, because I don't know that I can find the winner. They're all winning in a sense, right? Insurance is regulated at state level. They're competing for share in a large growing market. So it's not about finding the so-called winner. There are multiple ways here, although I happen to like this one, and I like some other ones like Corebridge, right? So talk about the sales growth. I have the AI drop in some verbatims from management, brings in the valuation. I love this stuff. I mean, this stuff gets me excited. It just makes it so easy. And analysts would take how long to generate a report like this? Imagine the analyst gave me a report and I said, go back and get management verbatims. I'd lose a day. Right? So I can go very quickly here. Highlight some risks for me. Looks like the formatting here is a little bit off. I don't know why there's so much bolding. I can even do things like, and I pin news. I pin news to it too. So we have a real-time news feed now. So, and then I have like an integrated chart tool. Check this out. Check this out. You're gonna love this. I have this button now called Ask the Trader. The Trader sucks, by the way. I'm still teaching it, but it's got some basic ideas, right? It looks for volume climaxes here. Those big bars. Notice that there, and it checks some basic technicals, and it says, hey, it may have potential for further gains. Consider entries near the moving averages. No red flags. Right? So I might say, okay, well, tell me about all the competitors. I'll push this button right here. So it's going to find all the competitors. Imagine you're a generalist. You're learning a category from scratch. So it finds, it missed one. It missed Corebridge. It got Lincoln. And then I've got the cases for all of them here. Check it out. Not those two, but I can go build those, right? So it's got Lincoln, AIG. I can compare them now. I can read them. What if I don't have time to read? Then I can push this button called Find Longs. I'm still developing this too. We have a team of engineers, by the way, working on this. So, by the way, check it out. I call it Stanley Druckenmiller idea. I'm teaching now how to think like Stanley Druckenmiller. By the way, this is my interpretation, obviously. What is it like? It likes Jackson. It likes Lincoln as a mean reversion idea. And I can ask it questions like this. Which of these names can buy back the most stock over the next 5 years and has sustainable earnings growth? Right? I can ask it that question. So it knows all the transcripts. It knows the entire context window contains all of those companies. So I can even ask it comparative positioning questions. I can ask about consumer behavior questions. It's pretty cool. So this is how we stay on top of a lot of information. It's technology. And if you don't have technology, you're out of luck. So give me a few months. I will make a wait list to make this available to the public. I have no idea what the hell we're going to do with this thing, though. I really don't know. We're iterating for our own use case. We know that if we get value from it, others will get value from it. That's it. We're eating our own cooking. We are our own persona. But it's a powerful tool. So anyway, that's that. I like this comment. Thank you. What the all-in podcast should be like. Learning a lot. Thank you. I appreciate that. Thank you. Drop into the Lumida Ledger newsletter this weekend. I hope you all have a fun Thanksgiving. I'm trying to figure out what to buy. I have a whole list for Black Friday sales. I can get the chili pad. I had the chili pad a few years ago. Then we moved. It collected dust in my basement. I kind of want to get the latest technology, or I think it's like 8 Sleep. 8 Sleep is the newest one. I'm gonna get the latest Aura Ring 2. I think my kids flushed the old one down the toilet 3 years ago. So, and the Whoop band just doesn't work for me. I think the Aura Ring is the way to go. So I don't talk about longevity enough, and I'm very, very keen on health and longevity. I got an NAD infusion 2 or 3 weeks ago, which is awesome. I recommend that. If you're over 38-ish, you should do that. Talk about that sometime. Some other things, by the way, I have some books can check out. So if you want to learn about investing in markets, this is a great one. Marty's Wags, Winning on Wall Street. It's a good one. If you want to figure out like the nature of reality, okay, these three are good thought experiments. So this book goes through like Einstein's thought experiments, by the way, like two trains running in the same direction, opposite direction, one's moving at the speed of light, all that kind of stuff. So, you know, if you're alone for Thanksgiving, read this one, okay? And another one is Time's Arrow. I was almost a physics person, by the way. Then I realized that it'd be 2 miles underground in it, Fermilab or something. And I said, that's probably not the best move. So Time's Arrow is a really interesting one. What is the nature of time? What is time? What is time? I mean, this is super, super interesting. This is a book that Naval Ravikant clued me into. David Deutsch. If you don't want to read this one, just go listen to every YouTube video the guy's ever made. And he explains the double slit experiment. And his conclusion, by the way, this is a real guy. This guy, the Oxford, I'm going to show this credibility for you before I tell you his conclusion. Cambridge and Oxford University. He's a fellow of the Royal Society and professor of physics at University of Oxford, where he's a member of the Center for Quantum Computation. His conclusion, from looking at the double slit experiment, is that there are multiple universes, by the way. I agree with his conclusion. And it took me 45 years to get there, but he explains it not in the most obvious way, but when you see his conclusion and how he builds it, I'm like, wow, shit, I think he's right. And if I were to summarize the argument for you very simply here, and I feel like these things are hard to do because you have to have background knowledge in the double slit experiment and quantum mechanics to get there, right? But the simplest way, if you have two slits and you're shining light, you get an interference pattern. Unless you have a measurement, the interference pattern goes away, right? That's the basics of the double slit experiment. So is light a wave or is it a particle? How does it exhibit both properties? That's so-called wave-particle duality, right? So he makes a great point that you get an interference pattern even if you shine one photon at a time. So the question is, what is the photon interacting with? There's nothing to interact it with. Right? If you're shining 1 million photons in a light stream through a laser, it's interacting with itself, other photons. His interpretation, if you send 1 photon at a time, it still creates an interference pattern, like 1 photon per hour. If you go back 100 days later, you will get an interference pattern. How is that possible? Because if it's 1 photon at a time, why isn't it behaving like a particle? His answer is that the particle is interacting with another particle in another universe. How wild is that? And I cannot think of any other possible answer to that. It's mind-blowing stuff. Did you guys hear about that orb over the Hudson River? What was that about? All right. Thank you for subscribing. Really appreciate it. Hope you all have a wonderful Thanksgiving. I have some exciting news on Wednesday to share, by the way. Some exciting news about Lumida as a company. Stay tuned for that. By the way, I'm hiring a CFP advisor in Wayne, New Jersey. If you know anyone, Wayne, New Jersey. I'm also hiring a CFA analyst or someone young, smart, and hungry, Wayne, New Jersey, that wants to work 7 days a week and is obsessed about investing. So those are 2 roles I have open, and a biz ops role as well, a biz ops role, business operations role. Preferably, they've been there, done it before. They come from a management consulting background. That'd be ideal. So if you can help me find those roles, I'd be really thrilled because we're growing quickly. We're having a lot of fun. Really appreciate the support. Thank you. Really appreciate it. And stay tuned. We're going to have that podcast with Vishal from Better Mortgage. We're going to have a few more really interesting guests. I was meeting one of my clients in Las Vegas. He is not retired, he's a young guy, actually, music producer. He worked with Quincy Jones, the music producer for Michael Jackson, and he's in rock and like metal. I'm like an 80s synth pop guy. He took me out to the Tears for Fears concert a few weeks ago, and he was talking about tokenization of music royalties and creator economy. And I want to have him on here soon too. I mean, it's just really incredible to see how creator economy and cultures looking at digital assets and tokenization to reimagine read, write, own, which is Chris Dixon's book. Right? Let's see here. Read, write, own. That's another good book, right? Chris Dixon. I haven't read this, by the way. I got this book in the fair or something. I've read most of these books, not this one. I get the idea. Read, write, okay, I get it. we live and breathe that one. Okay, so but take a look at that. That's another good book to take a look at too. All right, everyone, have a really wonderful Thanksgiving. Hope to see you on Wednesday. Take care now. Be well. Enjoy your weekend. Cheers.